My neighbor June did almost everything right. She started investing early. She never panic sold, never chased a hot stock, never paid an advisor a dime. If you handed her the list of 30 compounding rules that float around the internet, she followed 29 of them. She missed one. It cost her $146,000. The rule she missed was not obscure. It sat in the middle of that same list, in the same font as the 29 she got right. It looked exactly as important as the rule about which day of the month to invest. That is the real problem with these lists. They hand you 30 rules and imply the 30 are equal. They are not remotely equal. So I priced them, all 30 in the same unit, so you can see what each one is actually worth. 4 of them turned out to matter enormously. The other 26 added all together do not add up to half of those 4. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick, just what the math actually does over time. If that is what you want, hit subscribe. Before any of it makes sense, we need one shared measuring stick. Otherwise, 30 rules is just 30 opinions. Here is the stick. Money that grows at a steady rate doubles on a schedule. Not a vague schedule, an exact one. At 7% a year, $1 becomes $2 in about 10 years and 3 months. Call it 123 months. That 7% is the long-run return of the American stock market once you subtract inflation. The historical data comes from NYU Stern. Every 7% in this video is that number. It already has inflation taken out, so it is what your money gains in actual buying power. So 123 months is the clock we are working with. Every rule on that list of 30 either speeds that clock up, slows it down, or does nothing. That is the unit. Months. And I want to be precise about what a doubling is, because the whole video turns on it, and most content is sloppy here. A doubling is about the money that is already invested. Take whatever you have in there right now and ignore everything you add later. How long until that specific pile is worth twice as much? That is what the clock measures. That is a different question from how long until my account balance hits some target, which depends enormously on how much you keep adding. Both are real questions. They just have different answers, and mixing them up is where most of the bad advice comes from. For the next few minutes, we are answering the first one. The second one has its own layer later because 4 of the 30 laws only make sense there. Now, one more thing about the clock before we start pricing. Say your money grows at 8% instead of 7. The doubling then arrives in 108 months rather than 123. 1 percentage point bought you 15 months. At 6%, it stretches to 143 months. That same 1 point going the other way cost you 20. Notice how lopsided that is. A single percentage point up or down moves your entire timeline by a year and a half or more. That is why the rules that change your rate are in a different league from the rules that do not. And once you can see the months, the whole list sorts itself. I want to put 4 real people against this before we start, because 30 rules in a row gets abstract fast. 4 neighbors, all 52, all with $120,000 invested on the same Monday. 20 years until they retire. Dale does everything on this list correctly. June is the neighbor from a minute ago, who breaks exactly 1. Curtis breaks a different one, and Sharon breaks a third. Nobody breaks 2. Keep them in your head because we settle up at the end and the gap between them is going to be larger than you expect. The 30 laws sort into 5 layers. We start with the one that moves the clock most. Layer 1, the rate itself. There are 3 laws here, and the first is the most powerful rule you will hear today. Law 1. Own stocks, not a bond-heavy mix. A portfolio that is all stocks has historically returned about 7% after inflation. A 60-40 mix means 60% stocks and 40% bonds. That comes in closer to 5% because bonds have returned only about 2% after inflation over the last century. Run both through the clock, 7% doubles in 123 months. At 5% it takes 170. That one choice costs 47 months. Almost 4 years on every single doubling you ever go through. Nothing else on the list of 30 comes close. The full ranking is at the end, now, and this matters. That does not mean bonds are a mistake. It means they have a price, and the price is 4 years per doubling. A 35-year-old paying that price for a smoother ride is probably paying too much. Somebody retiring in 18 months is buying something real with it. A bad year at the wrong moment can force a sale at the bottom. The number is identical, and the right answer flips completely depending on how much time is left. The law is not that bonds are bad. It is to know what you are paying and to check that you need it. This is June's law, and she is the one who breaks it. She holds a 60-40 fund because it was the default in her plan and she never changed it. 20 years later, her $120,000 is worth about $318,000. Dale, who holds stocks, is at $464. There's the $146,000 from the top of the video. One default setting, never examined. Law 2. Own the whole market, not one company. This one is strange because in terms of the clock it is worth 0 months. Buying one stock does not lower what you can expect to earn. Your result might come in higher, it might come in lower, and on average it is the same. So on paper, nothing about your clock changes. What changes is the range of things that can happen to you. A basket holding a slice of every big American company cannot go to zero unless every company in it goes under. One company can, and companies do, all the time. So Law 2 does not speed up your clock. It stops your clock from being smashed. Those are different jobs, and you need both. I am pricing it at 0 months because that is what the numbers say. But 0 months of speed in exchange for removing the chance that you lose everything is a very good trade. Law 3. Accept the bad years as the price of the rate, also 0 months, and also essential. That 7% is an average across good years and terrible ones. Over the last century, roughly 1 year in 4 finished in the red. 26 of the last 100 to be exact. You do not get the 7% without also living through those 26 years. They are the same product, sold together. Every rule in Layer 3 exists because people forget this. Forgetting it is the most expensive habit on the whole list. That is Layer 1. 3 laws. One of them worth 47 months and 2 of them worth nothing on the clock while being completely necessary anyway. Layer 2. The leaks. Layer 1 was about your gross return, the number before anything is taken out. Layer 2 is about what reaches you after the taking. There are 10 laws here, and they all work the same way. Each one is a permanent percentage skimmed off the top every year, so each one slows the clock by a fixed amount forever. Law 4. Do not pay 1% a year for somebody to pick your funds. The standard advisor fee for an account this size is about 1% of your money annually. Take it off a 7% return, and you are compounding at 6. Your doubling stretches from 123 months to 143. That is 15 months. Every doubling. Forever. Put it in dollars and it lands harder. $100,000 left alone for 40 years at 7% becomes about $1.5 million. The same 100,000 at 6% becomes about $1 million. $500,000 for a service that in many cases means buying the same index fund you could have bought yourself. I want to be fair here, because there is a version of this fee that is worth paying. If a real advisor stops you from selling in one crash, they may have saved you more than they ever cost. We will price exactly what that is worth in Layer 3. What you should not do is pay 1% a year for fund selection alone. Curtis is the one paying it. His advisor put him in perfectly reasonable index funds and charges 1% a year to watch them. His $120,000 becomes $385,000 instead of $464. The fee took $79,000 for a service he could have replicated in an afternoon. Curtis is not being cheated. He is buying something he does not need at a price he never converted into dollars. Law 5. Use an index fund instead of the average active fund. An index fund is a basket holding a slice of every big American company. It charges you almost nothing because there is nobody to pay. An active fund pays a manager to choose which companies to hold. The average active stock fund costs about 0.6% a year. A large index fund costs about 0.03. That difference slows your clock by 9 months per doubling, and the manager you are paying for usually does not win. S&P Dow Jones tracks this every year. In 2025, 79% of active large company American stock funds finished behind the S&P 500. Stretch the window to 15 years, and there is no US stock category where most active managers beat their benchmark. I should say that the people who run active funds dispute how that scorecard is built. And there is a live argument about the methodology, but you do not need to settle that argument. You need to notice that you are paying 9 months per doubling for a coin flip that has been landing badly. Law 6. Get your old 401k out of an expensive plan. Workplace plans charge an administrative fee on top of the funds inside them. A high one runs about 1/3%. That is 5.5 months per doubling, paid to an employer you no longer work for. Rolling an old account into an ordinary IRA at a low-cost broker usually removes it. It takes an afternoon and a phone call. Law 7. Never pay a front-end load. A load is a sales charge taken off the top when you buy. The classic version is just under 6%. You hand over $10,000 and about $9,400 actually gets invested. Spread across 20 years of holding, that works out to roughly 0.3% a year. 4 to 5 months per doubling. There is no version of this you should accept. It buys you nothing. Law 8. Keep it in a sheltered account. Money in an ordinary brokerage account gets taxed along the way. Dividends are taxed each year, and every sale creates a tax bill. For a typical investor, that friction runs somewhere around 0.3% a year, which is 5 months per doubling. Move the same holdings inside a retirement account and that friction disappears. Same investments, same market, 5 months faster, purely from which envelope you keep them in. Law 9. Skip the robo fee if you can do it yourself. A computer-run service that builds and rebalances a portfolio for you typically charges 0.25%. That is 4 months per doubling. Unlike laws 4 through 7, this one is a real choice rather than a plain mistake. If paying 4 months per doubling is what stops you from panicking or from never starting at all, it is cheap. If you would have held a simple index fund anyway, you are paying 4 months for nothing. Law 10. Choose a low turnover fund. Funds that trade constantly rack up costs that never appear in the advertised yearly fee. A rough estimate is around 0.15% for a high turnover fund. 2.5 months per doubling. Small, real, and free to avoid. Law 11. Do not buy whole life insurance as an investment. Whole life sold as a savings vehicle carries costs that put its effective drag at 1% or more. That is 15 months per doubling, matching the advisor fee. There are narrow situations where whole life genuinely fits a family. Using it as your compounding engine is not one of them. Law 12. Watch the exit terms on an annuity. Most annuity contracts lock your money up for 6 to 8 years. Pull it out early and you trigger a surrender charge that often starts around 7%. On the clock, this one prices at 0 because it is not an annual drag. The cost is at the door, not every year. But that is exactly why it belongs on the list. A rule can cost you nothing per year and still cost you everything the one time you need your money. Law 13. Do not trade inside a taxable account. Every sale in an ordinary brokerage account realizes a gain and triggers tax you would not otherwise have paid yet. An active trader in a taxable account can easily add 0.3% of annual drag. That is another 5 months per doubling on top of everything else. That is layer 2. 10 laws, and if you were unlucky enough to be carrying several of them at once, they stack. A 1% advisor fee on top of an expensive active fund inside a taxable account is not 15 months. It is closer to 30. Layer 3. Staying in. Layer 2 was about money skimmed off your return. Layer 3 is about time when your money is not in the market at all. This layer works differently, and the difference is worth understanding. A fee slows the clock. Sitting in cash stops it. Money out of the market earns nothing after inflation, so every month you sit out is 1 month added to your doubling. Not a fraction of a month, a whole one. That 1-for-1 exchange rate makes this layer brutal because the amounts of time involved are not small. Law 14. Do not sell in a crash and sit out. The market will fall 30% while you are holding. Everyone gets one of those, usually several. Say it happens, you sell, and you wait until things feel calm again before getting back in. Feeling calm typically takes about 2 years because markets recover long before the news does. 24 months out of the market is 24 months added to your doubling. 2 full years from one decision made on one bad afternoon. That is more than the advisor fee, more than the active fund, and more than most of Layer 2 combined. Sharon is the one who does it. She held stocks like Dale, paid nothing like Dale, and did everything right for 8 years. Then the market fell, she sold, and she waited until it felt safe to go back in. She ends at $406,000 instead of $464,000. $59,000 for 2 years of feeling careful. Law 15. Do not sit out waiting for clarity. The softer version of the same mistake. You do not sell, but you stop contributing and let cash pile up until the situation makes more sense. 12 months of that is 12 months added. The situation never makes more sense, incidentally. There has never been a year when the news said, now is a good time. Law 16. Do not wait for a dip before your first purchase. This one feels like prudence and behaves like a cost. Going back to 1928, American stocks finished the year positive in 73 years out of 98. So roughly 3 years out of 4, waiting for a lower price means paying a higher one. Wait 12 months for an entry point, and that is 12 months on the clock, plus a better than even chance you bought higher anyway. This is the first of the rules that is worse than useless. Law 17. Do not switch funds after one bad year. The pattern is always the same. A fund lags for a year, so you move to whatever did well last year. You are out of the market for the days it takes to settle. Call it 9 months of disruption in a typical case. 9 months added, and the fund you left often recovers while you are gone. That is the second rule on the list that costs you rather than helps. Law 18. Close the behavior gap. Here is the one that measures all of Layer 3 at once. Morningstar runs a study every year comparing what funds return to what the people in those funds actually earned. The funds and the investors are the same funds, so any gap is created purely by when people bought and sold. Over the 10 years through 2024, the average dollar earned 7% a year while the funds themselves returned 8.2, a gap of 1.2 percentage points, which is about 15% of all the gains available. Put 1.2% into the clock and your doubling stretches by 25 months. 2 years, lost to nothing but timing. I want to flag an honest dispute here because this figure gets thrown around carelessly. A paper published this year reran Morningstar's own sample. It argued that bad timing only accounts for about 0.1% per year. Most of the gap on that reading comes from how the measure is built rather than from investor mistakes. So the true cost of bad behavior is somewhere between about 2 months and 25 months per doubling, depending on whose method you accept. Even at the low end, it is real. At the high end, it is the second most expensive item on this entire list. Law 19. Do not cash out when you change jobs. This one is not a delay. It is a different category of damage, and it deserves to be said plainly. Cashing out does not slow your clock. It deletes everything the clock has already done. Vanguard studies nearly 5 million American retirement savers every year. Roughly a third of participants empty the account when they leave a job. Somebody 10 years into a plan at $6,000 a year is holding about $83,000. Cash it out, and you are back at zero, having also paid a penalty and a tax bill on the way out. Rebuilding that balance takes another 10 years, so the price is not 15 months or 25 months. It is every doubling you had already completed. Law 20. Automate the whole thing so the decision never gets made. 0 months on the clock, and it is the law that protects the 6 above it. Every rule in this layer is a decision made in a bad moment. An automatic transfer that happens on payday without your approval removes the moment entirely. You are not buying speed here. You are buying the removal of your own worst afternoon. That is layer 3. And notice what just happened, because it is the point of the whole video. Layer 2 was 10 separate rules about fees and taxes. Fix every single one and you get back somewhere around 40 months. The 6 behaviors in this layer can cost you more than that from one decision. Layer 4, the pile. Almost everything to do with accounting laws gets the next part wrong, including versions I have seen presented very confidently. There are 4 rules that show up on every one of these lists, always near the top. Capture the employer match. Raise your contribution with every raise. Start now instead of waiting. Clear your expensive debt. All 4 are excellent advice. All 4 are worth 0 months on the clock. That sounds like a contradiction, and it is not. It is the distinction I flagged at the start, and here it is concretely. A doubling is a ratio. Your money doubles when it is worth twice what it was, and that depends only on the rate it grows at. Adding new money does not make the old money grow faster. Picture 2 identical accounts, each holding $10,000 at 7%. Into the first one you add nothing. Into the second you add $6,000 a year. Your second account is bigger every single year, and it stays bigger forever. But the original $10,000 inside it doubles at exactly the same moment as the $10,000 next door. Same rates, same clock. So what do these 4 laws actually do? They make the pile bigger. Not faster, bigger. A bigger pile doubling on the same schedule is worth enormously more in dollars. That is why these rules belong on the list even though they score 0 on the clock. Law 21. Capture the full employer match. Many employers add money to your retirement account when you add money to it. The common arrangement is 50 cents for every dollar you put in, up to some limit. That is a 50% return handed to you before the market does anything at all. Take somebody earning $45,000 who puts in 3% of their pay, which is $112 a month. With that match, $2,025 a year goes in instead of $1,350. Over 30 years at 7%. That becomes about $191,000 instead of $127,000. The match alone added $64,000. Their own money never changed. 0 months on the clock. $64,000 in the pile. Both true. Law 22. Raise the contribution every time your income rises. $100 a month held flat for 30 years builds about $113,000. Now raise that same $100 a month by 3% a year, roughly a normal cost of living increase. It builds about $155,000, 37% more, from a change nobody has to find room in their budget for. You are routing the next raise instead of absorbing it. Law 23. Start now rather than at a round number. Waiting to begin until you have a respectable amount is the most common version of losing time. $100 a month over 30 years builds $113,000. Wait 2 years and you end with $16,500 less, which is 15% of the outcome. A 5-year delay costs $37,000. 10 years of getting ready gives up 57%. Nobody experiences those years as a decision, they feel like a period of getting organized. Law 24. Clear any debt costing more than 7% first. This is the one law on the entire list that is not about your investments at all. Compounding is not only working for you, it works against you on anything you owe, and it works faster there. Your investments and your credit card are running the same machine. One is pointed away from you, and one is pointed at you. What matters is which one spins quicker. The Federal Reserve's most recent quarterly data puts the average rate on credit cards carrying a balance at just over 22%. The average balance among cardholders who carry one is about $7,900. That balance costs about $1,750 a year in interest. The same amount invested would earn about $550. So you are losing roughly $1,200 a year and losing it again every year, no matter how patient you are. 7% is the dividing line because that is what your investments can realistically earn. Anything charging you more than that is beating your best investment with certainty. No bad years and no waiting. Below the line, the answer flips. A mortgage of 4% is not an emergency, and money aimed at paying it off early is usually better off invested. 4 laws, all worth 0 on the clock, all worth having. The clock measures speed. These 4 measure size, and you need both. Layer 5, the noise. 6 laws left, and this is where most investing content lives. Law 25. Invest on the 1st of the month instead of the 15th. 0 months. Over 20 years, the difference amounts to a couple of dollars a month of eventual retirement income. Law 26. Rebalance quarterly instead of annually. 0 months, and quarterly is arguably worse because in a taxable account, each rebalance can trigger tax. Law 27. Pick this index fund over that one. 2 broad index funds from major providers differ by a few hundredths of a percent. That is worth a fraction of a month, and nobody can tell you in advance which one wins. This is the single largest generator of online argument in personal finance, and one of the smallest numbers on this list. Law 28. Check the account regularly to stay informed. 0 months at best and negative in practice. Checking more often does not change what the market does. It changes how many chances you give yourself to make a Layer 3 decision. And Layer 3 is where the expensive mistakes live. That makes it the 3rd rule that is worse than doing nothing. Law 29. Add a small sleeve of gold or something exotic. A 5% position in anything moves your overall return by a fraction of a percentage point in either direction. Somewhere under 2 months, in a direction nobody can predict. Law 30. Follow what the Federal Reserve does next. 0 months, and this is the one I would most like people to drop. Nothing the Fed announces changes the 7% long-run rate that your clock runs on. It moves prices in the short term, which only matters if you act on it. Acting on it is exactly how Layer 3 costs you 2 years. So there is the full list. Now, let me put them in order because the ranking is the whole point. Excluding the cash out, which is a reset rather than a delay, here are the 4 most valuable laws on the list. Owning stocks instead of a bond-heavy mix is worth 47 months. Closing the behavior gap is worth up to 25. Not sitting out 2 years after a crash is worth 24. Dropping a 1% advisor fee or not buying whole life as an investment is worth 15 each. Those 4 total about 111 months. 9 years and 3 months on every doubling you go through. Now add up all 26 others. Every fee item in Layer 2, every noise item in Layer 5, every 0-month rule in Layer 4. They come to less than half that. And that is the shape of this entire subject. It is not a list of 30 equally weighted rules. It is a handful of decisions that matter enormously, surrounded by 26 that mostly generate content. Look at what the top 4 have in common because it explains why they win. 1 is about your allocation, meaning how much of your money sits in stocks. 1 is about a fee. The other 2 are about not interfering. None of them requires you to be clever or to predict anything. Every single one is a decision you make once and then leave alone. Meanwhile, the 26 that are worth almost nothing are, almost without exception, the ones that require constant attention. Now let me settle up with the 4 neighbors because their numbers say this better than I can. Dale, who broke none of the laws, finishes with $464,000. Sharon, who sold in 1 crash and waited 2 years, has $406. Curtis, who paid 1% a year for 20 years, has $385. June, who never changed the default fund in her plan, has $318. Same age, same 20,000, same 20 years in the same market. The distance between Dale and June is $146,000. Neither of them ever did anything most people would call a mistake. June picked a reasonable fund. Sharon protected herself in a crash. Curtis hired a professional. Everything to do with people buying them has almost everything to do with the people buying them, has almost nothing to do with the cost. Each cost between $59,000 and $146,000. And there is a 5th person I did not introduce because his number ruins the chart. Say one of them had cashed out that account during a job change at year 10. They would have handed over $236,000 and started again from nothing. Now the part where I argue against my own video, because a ranking this clean deserves stress testing. The first problem is that the whole thing runs on a smooth 7%, and the market has never delivered smooth anything. I ran every 10-year stretch in the last century of American returns. 4 of 91 finished negative and 9 came in under 3% a year. If one of those decades lands on you, your doubling arrives late no matter which laws you follow. The rankings still hold because they are relative, but the absolute timeline is not a promise. The second problem is the behavior gap. I priced it at 25 months using Morningstar's figure. Then I told you a paper this year puts the real timing cost closer to 2 months. I put it second on the list anyway because even the disputed version is large and the mechanism is real. But you should know the number is contested, and anybody quoting it as settled fact has not read the argument. The third problem is the allocation law, which I ranked first. 47 months is what a bond-heavy mix costs. I do not want a 60-year-old hearing that has permission to move everything into stocks 18 months before retiring. That would be the single worst application of this video. The 47 months is a price, and near retirement it is a price worth paying. The fourth is that these laws do not all apply to everybody. If you have no employer plan, Law 21 is unavailable. If you have no taxable account, Laws 8 and 13 are already handled. A list of 30 is a menu, not a checklist. So here's what to do with all of this, and it takes about 20 minutes. Start with the reset, because it outranks everything. If you have an old workplace account from a job you left, do not cash it out. Roll it into an IRA. That single act protects more compounding than every other rule combined. Then look at your allocation, since that is the 47-month decision. Find out what percentage of your money is actually in stocks. Most people have never checked, and a lot of people are in a target date fund that holds more bonds than they realize. Then find your fees. Add up what the advisor charges, what the funds charge, and what the plan charges. Every full percentage point you find is 15 months. Then automate the contribution so no future decision is required, because that protects the whole layer that costs the most. Everything else can wait, and most of it can wait forever. 30 laws is what the internet gives you. 4 of them are worth 9 years. The rest are worth a look on a rainy afternoon. Not one is worth an evening of your attention, while the top 4 sit unexamined. If this was worth your time, hit subscribe. I will see you in the next one.